I am Anand. I am one of the partners in Ancon Consulting, and we will be taking you through our business plan, what is Ancon Consulting, and other details. So, the agenda again, it's an introduction to Ancon Consulting, discussion about our business plan, and any questions that you have. So, that will be the agenda. Now, about us. So, I am Anand and I have over 10 years of work experience in managing over 100 million cost for Fortune 500 companies, basically looking into financial planning and analysis processes within Fortune 500 companies for last 10 years. I have been into derivatives market for about last 2 years and yeah, so that's about me. Ashish is another partner. He has about 10 years of experience in IT, working mostly into HR systems, and he is a published author in Oracle, and he is very social person, so he has a lot of contacts and yeah. Now, the problem that I'm trying to highlight here is increased savings in Indian household, and there is a challenge to invest the savings with a decent return. Decent investment in equity stocks is tough. There are a lot of stocks, and there is a lot where you can invest. But the point is, what gives you a decent return and which with low risk? That's what you're looking for. That's what everybody looks for. In the current year, from January to end of November, Nifty, which is the benchmark index of India, is about 4% up. Having said that, only 25% of major stocks, so FNO stocks are the major stocks in Indian market, which hold most of the NSE market cap. So there is only 25% of FNO stocks that have outperformed Nifty, and over 70% have given negative returns. So my audience is this 70%, that some people who are holding these 70% stocks that have given negative returns. Another issue that is there in the market is high brokerage charges, fund management fees if you invest in future mutual funds. Again, mutual funds charges you exit load charges in case you want to pull out your funds prematurely. Then there are various business issues and other issues that impact share price of this stock. There's a transparency issue when you are investing in terms of the terms and conditions that are laid out. They are in fine print, and a lot of time you miss out a lot of important details. So there's a transparency issue as well in the market. Currently, the savings are invested majorly into bank fixed deposit, 6.5 to earning 6.5 to 7% interest rate. People invest in equities mostly following the tips from stockbrokers. Mutual funds, ULIP policy, insurance policies that again invest in the stocks. Then there are other government saving schemes and NSC and PPF, which are again government saving schemes. So that's where the major money goes in at this point. Now, the solution that I am proposing is index derivatives. Now, what the customer fears most about is stock market volatility. So, if you look at October and November months in Indian market, some of the stocks have lost 80% of their values. So, there is a concern about stock market volatility. Bad investment advice and tips. So, when stockbrokers give their advices, they have a lot of background research done, and on the basis of that, they provide those investment tips. Now, the point is, once our market environment in the market changes, business environment changes, those tips on the basis of a lot of research that has been done on the stock performance in the past, company's performance in the past, but the business issues that hits the market that can impact a lot. So these investment advices may be good at the time it was provided, but by the time investment was made, it can be bad. So those advices definitely are one of the concerns. Now, what the customer need is simplified investment product that they can easily understand, reasonable price for the services. Again, they want to pay the reasonable price, and they definitely want to invest their savings. They definitely have to invest their savings. Now, what do they want? No risk. They want reliable investment scheme. They want consistent return on investment. Now, what is the solution? The solution is index derivatives. And what do people get out of it? Higher income. Index derivatives are basically needs very small amount to be invested for a huge amount of basically turnover. So basically, you can buy say 10 lakh worth of Nifty just with the margin of 1 lakh. So it just requires 10 to 30% of the amount of the trade that you are going to execute. So that results in higher income as well. So yeah, transparent profit sharing terms. We will be laying out the transparent profit sharing terms, and that is what will be followed. So they are transparent. No investment confusion. We will be investing for the customers, so they do not have any investment confusion. And also, it's index derivative, so they know that the money is invested in index. No charges. We won't be charging any sort of fees to the customer. We will only be taking the profit from the profit sharing scheme. Features. It's hedged index derivatives. So as it has already been said, it's hedged. So there is a very low risk in these sort of investments and a high potential of the profit. Monthly settlement. So all the investments that are made are settled at the end of the month. So your profit and loss at the end of the month can be calculated, and yeah, low capital requirement. Yeah, so derivatives only need about 10 to 30% of the amount for the trading. So there is a low capital requirement, low risk. Now, since these trades are hedged, there will be a very low risk in terms of uh, very low risk when you invest. So you might lose in case the market goes totally. In case the market goes down too much, we'll still be losing only 1 to 2% of the money, even if the market goes down say 8 or 10%. So that's one of the features of this hedged index derivatives trade. Now the benefit: these trades are profitable, and they are highly profitable when the market moves upwards. So it will give you, say, it can give you a 10% return in a particular month itself. Liquidity: there's a lot of liquidity in the index derivatives market. So there's about $25 billion worth of trade happens every month. So there's a lot of liquidity. So anytime we can sell off our investment. Managed risk. So the risk is managed via hedging as well as by spreads. So there is a very limited risk in these investments. Diversified portfolio. We will be investing in index. So and index is made up of various companies. So for example, Nifty 50 is made up of India's top 50 companies. So when your fund is performing, it's performing on the basis of those 50 companies. So it's a diversified portfolio where we will be investing. Now, based on the last 12 years Nifty data, 30% return in investment fund is expected. So, and definitely in Ancon's rate of return will be 90% before tax. So, yeah, so 90% of the amount invested, Ancon's capital is what Ancon will be getting. Why now? Now, let's look at the performance of Nifty from January to November. Now, at the December end, Nifty was at 10,477, while at the end of November it was 10,858. Though it represents just a 4% high increase in Nifty, what has happened in between? There's a lot which has happened in between. So Nifty has gone up to 11,677 and Nifty has gone down to 10,125. So there has been a lot of fluctuation. Also, if you look at from the stocks perspective, when I look at all the FNO stocks, basically 25% of the stocks have outperformed Nifty. So there were 4% and above, there was a rise of 4% and above, and about 70% have given negative returns. So yeah, and the chart, these blue ones in the chart represents all outperforming stocks and the orange ones represent the underperforming stocks, and this line represents Nifty. So as you can see, in January there was about 160 underperforming stocks and about 40 overperforming stock. Now when we switch to February, we have about 130 odd underperforming stock and we have about 70 overperforming stock, and the list goes on. So now why should we invest now is Indian market is volatile and it is expected to be volatile in medium term because of a lot of Indian economic macros. Now we have elections next year, national elections. Rupee has been moving quite a lot in the last 3 months. So rupee has gone up to 73 and then it has come back to 70 and it has been trading in that range ever since. Oil prices hit 75 and then now they are at 47. So there is a lot of movement in oil prices and that has been impacting oil companies and again the market. Pharma has been underperforming since last year. So there is expectation that pharma will be recovering next year. But again, having said that, there is very less improvement that has been seen until now. NBFC. NBFC is one sector which has come under the radar. Once there was a news on ILFS, liquidity issues with ILFS. All the NBFC stocks has been underperforming. For example, DHFL is down more than 50%. India Bulls is down more than 40%, and there are all the other NBFCs which are down about 20 to 10 to 30%, in the range of 10 to 30%. So there has been a lot of hit on the NBFC stocks. Now, since there has been a lot of underperforming stocks this year, customers will be open to newer ways of investments. Most of the major mutual funds, if you look at, they have all given negative returns this year. Mostly the positive returns providing mutual funds would be where the funds were heavily invested in IT. Those are the funds where you have which would have made much money this year. There is a forecast of slowdown in China and sustained economic growth in India by World Bank. So when there will be slowdown in China, the investment will flow through in India, and sustained economic growth will help in terms of their decisions in investing in India. Liquidity in trade derivatives market has improved a lot in Indian market, so that is also a plus point. Market size. Monthly trade value of index derivatives in Indian market is greater than $25 billion. So that's a huge market size in terms of investing. Household savings rate in India is up. In 2017, it was up 2%, from 23% in 2011 to 25% in 2017. Only 4% of household savings is invested in mutual funds. So there is a huge market that can be captured. Household savings invested in fixed deposits is huge. It's 40%, and it just gives you interest rate of 6.5 to 7%. So there is a huge market that can be converted from fixed deposits into mutual funds and other funds that invest in the market. Now, what is our competitive advantage at this point? We will be the first fund in the market which exclusively deals in index derivatives. So that's one competitive edge. There will be no charges for fund management. We will be managing the loss with hedge. So even if the market goes down 10%, the customer will only be losing a percent, and then next month, once we make money, we would be able to cope those, and we ultimately will be able to the turn the fund into profit. Diversified portfolio, we will be investing in the index. So the portfolio will be diversified because the index is made up of various stocks. Higher income in comparison to fixed deposit and other savings scheme. There will be higher income because when the market moves 5%, we actually tend to make about 20%. When the market goes down 5%, we will still be making about 10%. So every month we would be making on an average 5%. So I said it's 30%, but that's the minimum. But if I look at the median, I would say we would be able to make about 60% every year of the total funds, and that will convert. I'll come back on the other slides how that converts into Ancon's profit. No confusion in making the investment decision. So yeah, customer would not have any confusion in making the decision because we will be making the decision for them and investing the money. Business model. So we will be investing in index derivatives trade with hedges and spreads. So we'll be hedging the futures with the options. We would be putting spreads such as bull call spread, bear spread, etc. So that will be our trading strategy. I will discuss it in more detail on the next slide. profit sharing model. So when we make 10%, when the funds make 10%, customer makes 10%, we make 10%. When the fund makes 15%, customer makes 10, we make 35. So when the funds make 50%, customer makes 15%, we make about 190%. And when it makes 60%, again customer gets 15% and we get 240% of our capital. Revenue schedule is on the basis of 30% return. So what we are saying is we will start with 30K in year 1 and we will have 725K in the year 5, and customer payout will be 0 in year 1 because there will be no customers, and it will be about 290 in year 5. So our profit before tax will be about 435K. Now, what is our trade strategy? So let me discuss one straight trade strategy today. So on the expiry day, buy the index option at current strike. So for example, if the index is at 10,800, buy 10,800 put, and then buy go 400 points below and sell two 10,400 puts, then buy Nifty future and then buy 11,000 put. Now, how this will work? Now, when the index moves up, if it goes up to 11,200, we will make a profit of about 150 that will turn to 10,000 on an investment of 2 lakhs. If the market goes down and index ends up at say 10,400, we will be making round about 300, that's about 20,000, that's on the investment of 2 lakhs again. So it depends how much the market moves, and that will decide on how much will be the profit. But majorly the profit would be in the range of 5 to 20% depending on the market move. Loss scenarios, there could be small losses in case the index doesn't move. So if the index is at the same point from where it is started, we might lose say 1% of the capital in total. If you need any more details on this trade strategy, you can email me at contact@consultancon.co.in. Customer acquisition. So what we are expecting is we would need to acquire about 700 people, and the minimum amount we would be taking is 700, and all these calculations are on the basis of $700 taken from each person. So we would be requiring about 700 people paying 700 each. Then it will grow to about 1061, and then in year 5 we would have to acquire about 3000 people in total. How we'll do it? First will be the marketing. So we would have to hire DSAs, we would have to go through various channels to convince customers to invest into our business. Website will be another way to drive people. Referral program. So about a couple years from now, when people have invested, they have got their returns, they would start referring and we would pay them some amount for the referral. Current status. So I have about 10 years of financial results analysis experience and couple years trading into derivatives. So, and I've done a lot of research on index derivatives during that period. So that's one thing. I have raised about 10K to start the business, and I'm expecting to start the business in Jan 2019, though it might be delayed for a couple months because my registration LLP registration is just we have just started, so it might take a couple months to get the LLP registered. So that's the status. Financial projections. So what we are expecting is greater than about 40% return on investment. Uh, our key metrics would be trade executions as per the agreed strategy, higher return than Nifty, and customer acquisition will be another key metric. In terms of profit projection, we are expecting it to start with 20K in year one and reach up to 278K in year five. And these projections are based on 30% profit on funds. What I'm expecting and uh, which is most probable scenario is we actually getting about 50% return every year. So what I will be expecting is about 33K profit in year one, and that would go up to say about 800K in year four. So that's my realistic expectation. That is more realistic expectation actually. Projection. So fundraising, we are looking for about 100K, and we would be seeding about 49% equity interest in exchange of 100K. Uh, we would be trading on index derivatives with hedges and spreads as discussed, and 30% profit in first year of operation is minimum that we are expecting, and that turns into 30K revenue over 12 months. Risk. What is the risk? Now, what this slide represents is monthly average movement and standard deviation of Nifty movement. And this has been calculated on 5-year basis, 3-year basis, 2-year basis, and 1-year basis. So what it says is Nifty moves on an average 5.5% every month. So if you look at from 5.5% perspective, if the Nifty moves up 5%, we would be able to get about 15,000, and that is around about 7.5%. In the month it moves up 5%. If it goes down 5%, then we would be able to make about, again that will be about 215%, 7.5%. So that's what we are going to make if Nifty moves 5.5% every month. If it is lower, then the profit would be little on the lower side, but we still expect to make about 5% every month. And any queries on this, I can again take it up, and I can reply back to you in terms of if you specify what sort of specific detail you need on this one. Nifty yearly returns. So in 2014, Nifty gave a return of 30%. 2015 was -3. 2016 was 2%. 2017 was again 29%. 2018 is 4%. 2019 is again expected to be in the range of 4 to 5%. So it would be say between -5 to +5%, and I would expect 2020 to be somewhere around 20% return. So that's what the Nifty long-term charts has been able to I've been able to gather from the Nifty's long-term charts. So any question and answers, you can email me on contact@consultancon.co.in, and my mobile number is 8777405305. You can also visit our website at https://consultancon.co.in. Thank you for your time. Bye bye.